They're not fucking geniuses.
Yeah, but I disagree with that because traditional structuring is not an asset. Structuring it as a smart contract, eliminating counterparty risk, it's just not there.
But I think servicing risk is important because so much of the risk in a security like that is one, servicing risk, and two, the cost of doing all of that. And you can automate it, make it efficient, and then leave it and sort of remove any of the sort of collecting from a depository trust, a centralized entity. It goes direct. That's a huge efficiency gain. It should democratize access.
There's also balance sheet risk and
absolutely.
the balance sheet risk. You have counterparty risk to the bank, and you have counterparty risk to your actual counterparty. The bank becomes a de facto counterparty. There's no counterparty risk in a smart contract with the funds escrow. Zero. I mean, we can go through many attributes. It's not like I'm super smart. It's a technology shift, so we changed the business model, like I explained. Banks sell out of inventory. If you go to a bank and you want to buy something, they have a menu. You can have what's on the menu. Don't get creative, or you can get creative, but then you can almost never profit from it. If you do profit from it, that means you have extreme inside information. Take a John Paulson with the trade, the CMBS trade, where he made his name and $1 billion. I actually did the exact same trade. But I did it retail with options. I had a phenomenal return. I called Bear Stearns and Lehman Brothers very, very easy. Because remember, I just came out of real estate. So I knew anybody who did business with me was going bust. So I simply bought a bunch of puts. I was buying puts at 5, 10, 25 cents on the contract. They were shooting up to $86 on the same contract. And this was no leverage. It got to the point where I've been leveraged it, but my nose was bleeding from the volatility. John Paulson did a very similar trade. He allowed the banks to custom make a swap. He made a lot of money. Okay.
He custom made it and then bet against it.
Right.
And the banks were paid so much to do it, they thought, okay, this is
he
great.
didn't custom make it. The banks custom made it for him.
No, he actually had his guy make it.
Well, he had his guy in the bank. Found out.
No, he had his head trader, who I worked with at VeADIR, actually make it at Deutsche Bank.
Well, he made it at Deutsche Bank, so the banks made it.
No, they made it for him, but they.
Well, that's the point. The
he
banks.
was the chef, so he sent his head trader into Deutsche Bank and said, "Here's the recipe."
Yeah, but he came in.
They executed for it.
As I correct me.
Which makes it more egregious, by the way.
Yeah, so he came in and he custom picked the mortgages out of the selection pool. So he didn't want anything before anymore. He custom picked this.
He customized a piece of shit and then he bet against it.
So now I got sidetracked and forgot what my point was.
It's a really nice piece of shit though.
So I forgot what my point was because I was sidetracked. What was I talking about? If nobody knows, then it was okay. Well, anyway, long story short, they will charge you a lot. Now, you're in a CDX or TRS, total return swap. You're really, really deep in the money. Okay, the bank is having problems. You want to unwind. You can only unwind into another TRS. Do you get cash out? Okay, these issues, and they do happen. I've known people this happen to. All the banks said we'll get you into another one. Okay, because the bank couldn't afford to get out of it. All these issues are eliminated if you have peer-to-peer contracts. Okay, the contract says you'll get cash at the end of this period. You get cash at the end of the period. It doesn't really matter if you made a mistake, if you did well, you did bad, etc. Okay, the way the current structure works, banks cannot do that, and they will not do it because it doesn't work in their best interest. What makes it most egregious to the banks and beneficial to us is our compensation structure. What many would consider a fund, we have at a flat 5%. Okay, if you go to a sell-side institution, the asset management side, 60% of gross revenues goes to compensation. That's salary, bonuses, etc. 60%. 50% on bad days. The worst I've ever seen, or best, was 48%. So if I start off at 5% as a ceiling, there is no sell-side institution that can compete. Even if they wanted to drop compensation. Goldman drops compensation, all of their true inventory, because they don't do anything but come up with ideas and trade stuff. All their true inventory, which is their traders, bankers, run over to JP Morgan. JP Morgan drops it, they run over to Morgan. Okay?
Cheaper cost.
Right. It is impossible for the industry to match a 5% or anything below, I'd say 40% gross. Absolutely impossible.
Because they can't even pay the freaking salaries.
Right, and that's just salary. That's not SG&A and everything else. That's not cost of running business. That's just compensation. That's the structural deficiency.
That's paying you to go home.
I mean, that's kind of the whole thing. That's the point that I've made to a lot of people is that, you know, I work with a lot of different corporations. Compensation on average is 20 to 30%
Right,
of
exactly,
revenue.
yeah.
And so when you have the financial industry with 40 to 60% of revenue being spent on compensation, that's a lot of fat to cut
That's
out.
straight up bullshit.
And then you have to run the company. Then you have SG&A. You have you know, everything else.
It's just a compensation inflation. I mean, there's
It's a compensation vehicle. Remember, it's
they're not
not.
adding value.
It's not an asset class. It's not an investment. It's a compensation vehicle. Now, okay, Wall Street, the financial industry, but investment banking, Wall Street, not necessarily commercial banking, is the only industry where the employees make more than the owners of the company. The only industry. Okay, I would say hedge funds, but theoretically, the owners of the company are the GPs. So, you know, they make a lot, but they own it. But, you know, not to hit the hedge funds, but they own the company, but they take very, very little risk. You know, they probably start off with a capital of their own. Once they scale up, the risk is borne solely by the LPs. The way hedge funds are set up, you have a free call option. So you have a call option you didn't pay for. If things go up, you participate in it. If things go down, it doesn't really matter. Not only do they have a free call option, they have a standardized put that they also got for free. So if everything does go down, they get less money, but they still get paid for the management fee. So the structure is counterintuitive to the investor unless you have a raging bull market. But if you have a raging bull market, you shouldn't need a hedge fund. Many hedge funds only invest in leverage beta.
That's why you see the rise of all the ETFs and passive
Right.
management.
Right.
And I mean, they're not even beating the market anymore, and everyone's just buying these ETFs. But when the market turns and then there's forced liquidations, it's this
Right.
Feedback loop that perpetuates the crash.
Now,
Bingo.
I don't want to pick on like any particular group. Our solution is to be research driven. Okay, so it's not necessarily active management; it's active research. You know, I really believe in numbers. I really believe in digging down and finding the truth. When I found VeADIR in trouble, I simply did a debt to equity search. Okay, and I understand the industry a little bit, so I understand you should be looking at the balance sheet and you shouldn't be looking at the income statement. But sell-side analysts focus on the income statement because their job is basically their job is marketing support for the traders. You know, that's basically what the sell-side analysts do. Okay, focus on the balance sheet. You see cracks before they bust wide open. I did Bear Stearns, I did Lehman Brothers, I did General Growth Properties, Countrywide, Washington Mutual. I did the entire European EU, starting with Ireland, Portugal, Spain, Italy. The Spanish and the Italian banks are still a mess. You can't sue them because they publish this. If you pick up their annual report and you go through it, just the way you go do it through an annual report, you take it, you turn it upside down, start reading from the last page at the fine print. By the time you get to page 20, it's like a horror movie. But you can't sue them. They published it, they made it free. Most analysts obviously chose not to read it. By studying the truth, you could go a very long way. You can be wrong and still beat a lot of the competitors because the competitors have a perverse incentive. You know, their job is not to find the best performers or the worst performers to go short. Their job is basically marketing support for moving inventory. Now, not many people are going to say that, but you know that's the way I see it. Do you think I'm wrong?
No, I think you're right. I think the bigger issue is that I think there's a huge opportunity for whatever, you know, for all of this technology to address the huge imbalances of capital in society.
Right.
I think that's kind of what you're trying to get at. And I think that addressing that through smart contracts, through crypto, through the blockchain there's really never been something that can probably address it so clearly and efficiently.
And quickly.
Quickly.
Mm-hmm.
And you don't need gatekeepers who are not incentivized to address that to get involved, whether it be the government. Right. So I think that's what I find very intriguing about all this. And I think structuring things and, you know, that's all sort of like a commodity in the grand scheme of things, right? Like all that shit can be addressed, but I think the intriguing thing about crypto and blockchain smart contracts so that you can create units of access to information, knowledge, capital that can be truly transparent, which effectively makes it less risky, which is really